Welcome back to the Real Estate Reserve Podcast. Jason Bale and Hard Money Bankers co-host Ian Horowitz from Equity Warehouse. Hope everyone's doing great. Glad we have another really, really good guest lined up here in a second. If this is your first time tuning in, welcome. Promise we will keep this fun, educational, emphasis on fun. But, as you all know, our show is geared towards real estate investors, business owners, marketers, entrepreneurs, and anyone that's looking to kind of advance in life through financial freedom. So it's going to be fun. If you're a return viewer, follower, watcher, listener, thanks again for all your support. We certainly can't do it without you. Today's guest is a special one. Alan Franks is a certified financial planner, also the author of Empowered Money out of Atlanta, Georgia. So I'm definitely looking forward to this conversation that we're going to have with him here in a little bit, Ian.
Yeah, we should have pressed record earlier on because we were talking about how great the Phillies are over the Braves and why the Braves are so horrible. But we'll skip all that talk for the end. Guys, if you get any value out of this show, especially since I'm talking about the Phillies, feel free to share the show. We don't care about the likes or subscribes, but it is the best compliment that we can give our guests. So if you guys get any value out of this, please share it. And enough about us because we want to deliver value. Let's bring in Alan. What's up, brother? How you doing? All the way from Atlanta, Georgia.
Yeah. Hey, guys. Thanks for having me today. Looking forward to hopping into it. I did bring a friend with me here. This right here is the best mascot in the world. This is Blooper, the Braves mascot here. Puts the Philly fanatic to shame here. This guy's hip thrusts are unbelievable.
All right. Well, that's enough baseball talk for now. We'll debate this at the end because I don't think baseball betting is in anyone's financial plan to get rich and survive for a long period of time unless you're an odds maker. So with all that said, like Alan, I guess, how did you get into financial planning? Like, I could ask you about what you do. It's kind of obvious, and we'll get into it deeper here. But how did you even get into financial planning?
Yeah, man, I got into this for the best possible reason, and that's out of pure desperation, right? So I graduated. I studied economics at Mercer University in Macon, Georgia. Graduated in 2010, and had no jobs, man. I thought that I was going to get out there and be a jet setter for Boston Consulting Group or something of that nature. But the truth is that my parents were entrepreneurs, my grandparents were entrepreneurs. And so when I walked into a commission-only sales office and they said there wouldn't be a salary, I was like, of course there wouldn't be. Why would there be, right? Yeah. So I started out at a firm. I'm not going to mention the name because I don't want to be mean here, but I learned a lot in 5 years. And what I learned, most importantly, what I didn't want to be when I grew up, which was a commission-only salesperson, right? And so that firm wanted me to go a mile wide and an inch deep and sell their products. And I wanted to go the opposite, which was a mile deep. And so when I married my wife, Allison, we moved to Atlanta, switched firms, and that's where I started doing fee-based financial planning. In general, if you look at the industry out there, you're going to have two types of advisors. You have a brake pedal and a gas pedal. The brake pedal is going to sell your life insurance and disability insurance and annuities and all that stuff. And if you get into a car with only a brake pedal, you're going to be super safe, but you may not like where you're going to end up, right? On the other hand, you have the investment advisors. So that's purely gas pedal. They don't care crap about financial planning, estate planning, anything of that nature. They just care about portfolio. So we decided, why in the heck would we not build a car with both a gas and a brake? And while we're in there, let's add in a lot of other benefits like cash flow management, helping people choose their employee benefits, and a lot of real estate talk with debt and leverage. We believe wealthy people understand leverage and debt and how to use it, but most people do not, right? So we have a lot of education with our clients about how they can leverage a little bit of their money to leverage a lot of other people's money, time, and experience.
Yeah, that's an interesting point about leverage and like utilizing it to grow wealth. I was a fireman for the city of Baltimore. That's how I got my start. I was like, well, I can't buy enough stocks to make enough money, but these dumbasses are willing to give me money and I can only put down 25 grand and buy $100,000 house. I was like, this is a no brainer because you're basically financing my future net worth. So with all that being said, like, leverage is a great tool. How do you make sure that your clients don't go, oh, leverage is amazing, and they just go balls to the wall? Like, how do you build that into the financial plan and make sure leverage is being used in the proper fashion?
Yeah. But first of all, I have to get them over the hump of understanding that, hey, maybe not having any debt, like certain financial advisors all over Instagram will tell you pay down your house as quick as possible. So first of all, it's a lot of education to say, actually, that's not a really good thing, right? And helping them understand that, hey, if you put 50 grand down on a $500,000 house, and that $500,000 house earns 10% rate of return and grows to 550, you didn't earn 10% rate of return. The house did. You earned 100% rate of return. Your 50 grand turned into 100 grand, right? So it's helping them to understand that. And once they do, that sort of clicks. Now, here's the truth. The way that we oftentimes help our clients find the money to invest in these things is via their lines of credit, whether it's a home equity line of credit or a securities-backed line of credit. And with that, they have to understand a couple things. Number one, they have to be able to float the interest payments on those lines of credit, right? Number two is that they have to make good decisions on where they put that money. And so we like to find stuff that's safe and produces an income stream. The income stream helps pay the loan off, and the safety helps just ensure that, hey, we're not doing something that's going to go under. Now, obviously, guys, that lends itself to real estate. You can loan against your assets all day long to go put money into a business. Sure, shoot, I hate to say it, you can even loan against your house to go buy stocks. I wouldn't recommend it, right? It's way too volatile out there. So when we're looking at, okay, if we're going to take this, it is an additional risk, right? And to be clear, there's two risks in life. One is market risk of things going up and down, and the other is the risk of not earning enough money to live your best life, right? Right. So it's almost risky to be too safe. Right. And so we got to be concerned about that. Right. So in general, when we're looking at, hey, where do we put this stuff? In general, it is going to be into a real estate. And lately it has been hard money lending.
What's your philosophy on paying off debt versus investing first?
Man.
And I know that's a tough one. And
Totally.
I'll follow up with that here in a second. But
yeah,
just because we're digging deep into this conversation.
I think it's important for us to realize when debt becomes toxic. Okay. So a credit card debt is going to be different than a mortgage debt, right? So if we're paying 28% interest on credit card debt, that's going to be one of the first things that we need to address in any planning engagement, right? And how are we addressing that? Well, we're going to look at transferring that loan over to a 0% balance credit card first, right? And then we're going to look at, okay, maybe we can get a home equity line of credit to refinance it at a 7% interest rate. Right. And so those are some things that we're going to look at first. Now, obviously, that is very bad debt. I think people know that we're going to address it. But what you're really asking is, okay, we've got a mortgage here at 7%. We got a line of credit out here at 7%. I just got $100,000 from the sale of an asset, maybe some income. Do I go invest that $100,000 and hopefully get 7%? Or do I go pay off that debt and get basically a guaranteed 7% rate of return because I'm paying off that debt, right? And the truth is, I believe it's called the Millionaire's Dilemma. And what it comes down to here is the idea of compounding interest, okay? So if you have $100,000 and you invest it and you make 7%, okay, you're going to have $107,000 the next year. And that's going to be making money. And then you're going to have $115,000 the next, right? And in general, that $100,000, following the rule of 72, that averages 7% will double every 10 years. 100 will become 200, 200 become 400, 400 become 800. Okay. On the other hand, compounding interest also works the opposite direction here. So if you have a $100,000 loan and you pay off some money here, all right, well, the next year that 7% is only going to be on $90,000, right? And the next year, $80,000, right? And so we look at that. We call this the Millionaire's Dilemma right there. Once again, wealthy people understand how to utilize debt. And so in general, I am a bigger fan of investing that money and having it double every 10 years and then paying that debt off in more of a systematic and automatic way.
Yeah, no, I agree with you. I'm just curious of your philosophy. And I'll tell you the reason I brought this up. And, Ian and I are overlapping a lot of different businesses and we pretty much talk every day. And I haven't shared this with Ian yet, but I a lot of people kind of that are, I don't know, not entrepreneurs, not business owners that Ian and I both overlap with. They follow like Dave Ramsey's type of stuff, right? And a lot, and we're very, I'm not saying anti Dave Ramsey, but like it's different.
Oh, I am.
Right. And but I will tell you, and I came up with this the other day and I was telling my business partner, Chris, this in the office. I was like, I am not a fan of Dave Ramsey on his platform, but I am a fan of Dave Ramsey on other people's platform because I've heard him speak on Hermosi's platform and I've heard him speak on other stuff. And the stuff that he's discussed is way different than the stuff that he discussed on his own platform. And maybe that's because it's a different audience. So that's where, and I think that's where it comes up of like, hey, his target audience, it's not relative. Like I don't agree with it at all. And most of, I think all of our spheres for the most part, and if somebody's just listening and they're a new real estate investor, that's the same thing. Like you're not necessarily categorized that way. But when he's on other people's platform and he talks about what he does kind of with his own portfolios and things like that, that makes sense. And everyone's like, well, you can't get an infinite banking policy. I can't invest because I haven't paid my car off. I can't, buy this house unless I only buy it in cash. And it's just like, so it was interesting. And he was also, a lot of his go-to philosophies were based off of 40-year game plans.
Yeah.
And then a few people that, were the hosts were like, yeah, but what about a 5-year game plan or a 3-year game plan? And then you can readjust and you can take on debt if it's going to be short-term debt. And it was interesting because his tone changed a lot. And it's like, okay, so he actually he does have philosophies that I think a lot of successful people would follow. He just doesn't portray that on his own platform.
What I admire about Dave Ramsey is the reach that he has. I mean, this guy's a hell of a marketer, right? He's definitely toned into something that's really worked. And I want to say this. He has helped probably millions of people at this point get out of debt. And you got to respect the hell out of that, right? That is not what I do for a living, though. I help people build wealth. He helps people get out of debt. Two totally different things, right? And so if somebody is in a lot of debt, I would gladly say, hey, you know what? You need to go do a Dave Ramsey course, right? And then when you get out of debt and you have a lot of extra money left over, right? Come see me, right? But on the other hand, we see people that really like to pick and choose their favorite parts of Dave Ramsey. And next thing you know, all their money is going to pay down their debt and no money's really going to their future. So sure, they're debt free at age 45 or 50, but man, they don't have anything saved up or invested. And so, once again, I greatly admire what he's been able to build. My gosh, it's obviously striking a tune that people like, and it's helped a ton of people.
Well, yeah, think about it. If you're trying to lose weight, you need to be told, carbs are horrible for you. But in reality, carbs serve a purpose depending on what you're doing, right? So it's the same thing. He has to speak so aggressively to make the pendulum move for someone. Totally. You bring up a good point. We're in that 40 to 50-year-old range. I can't believe I just said that and came out of my fucking mouth.
But you don't look over 60, Ian.
Thanks, man. I've looked like this since I was 16, so I'm growing into my age. So that being said, let's just say Jason or I had an exit. You get $1 million. Yeah. You can pay off your house. You got $500,000 or $1 million in debt. Have you done math? Because I'm sure you've talked to clients to say taking $1 million out of investing today will impact you by how much tomorrow, right? We're in that 40. Let's just use 45 as the mid range here. You're going to be on this planet for another 40 years, we hope, right? How much money are you losing by taking $1 million and not investing it into something that earns a minimum of 7%, right? Which we're in the business, so we should be able to do way better than 7%. To me, it's just ludicrous. You're lighting money on fire by paying the debt down. I understand some people have that knot in their stomach and they can't survive having it hanging, but man, it's got to be a gigantic lump sum that you're missing out on.
Well, let's look at these two scenarios here. Number one, just keeping it simple, the rule of 72, that $1 million is going to double, right? And let's say you're going to retire at 65 and you're 45, right? So that means $1 million will become 2, will become 4. That's significant money right there, right? But then let's take it to the next level there. We can then go and get a securities-backed line of credit, aka more debt, right? And then send that money over to Jason, borrow against it at 7, get whatever Jason's able to get on the hard money lending. And now all of a sudden we have $1.50 working for you. Okay. Right. So that is how wealthy people invest, right? They actually don't put money directly into real estate. They don't put money directly into businesses. They actually, most people, obviously speaking generally here, will put their money into the markets because that is a rather stable way of growing money. And they'll borrow against it so that not only do they have $1 working for them, they have $1.50 working for them. right? And that's another a form of leverage right there on that. Now, let's compare that to paying down the mortgage, right? I need people to understand this, right? The equity in your home is doing what we call Butarski. Okay, Butarski was a character in Animal House whose GPA was 0.00. Okay, that is the equity in your home. That's its performance. It's worse than a bank account. Now, you say, well, my home's growing. Yes, the asset's growing, but that equity that's in there, right? Number one, is somewhat hard to access. Yes, you can get a HELOC, but man, it's expensive, it's time consuming, and it's only going to go up to a certain extent, right? And then is not earning anything, right? So how do we get that equity to earn something? And if you were to just go pay off your home and you have more equity, right? It's, once again, these home equity loans, they typically only go up to a certain limit. So you're going to have some liquidity risk there as well.
Yeah, that's a really good way to explain it. I think it makes a lot of sense because it's just interesting to hear how people think about it. And I would agree with you that, the net return, you pay off your mortgage, cool, you're saving $3,000 a month. But Jason and I talk about this one all the time is that $3,000, I don't care how good of your saver you are, it's eventually going to end up in your operating budget. And you're going to, some way, shape, or form is getting spent, So it's interesting to see how you look at that and using your home as an asset in your total financial plan. From a financial planning standpoint, obviously we do a lot of real estate and it'd be easy to talk about that, but it'd be fun to talk about some alternatives that go hand in hand with real estate. Like, as real estate investors, Jason more than me have some active income. Like, you have good vehicles to offset some of that, like 529s, IRAs, like anything like that you come across that's kind of unique?
Yeah. I mean, you hit the nail on the head here. So guys, when we're doing a financial plan, the biggest obstacle to somebody reaching their goals is going to be their expenses, right? And my clients' largest expenses are taxes. So when we're doing financial planning, we're looking at this saying, hey, how can we help them save in 3 areas? Income taxes, capital gain taxes, and if we do planning right, maybe even estate taxes. Right now, they just set in line $15 million per person, so not many people are above that $30 million mark. But when you look at how your wealth is going to grow over time, if you do this thing right, you might be getting in that ballpark, right? So there's a lot of really fun estate tax planning ideas we can do when people are above that, right? But as you mentioned, and Jason, I don't know if you know a way around this, but the one challenge we've had with hard money lending is this taxable income, right? And so if you're, let's just use easy math here. If you're borrowing from a line of credit at 7 and the hard money lender is getting 17, you're netting 10. Well, shoot, man, if you're in a high tax bracket, 4 of that's going to go to Uncle Sam, right? So, once again, what do we like about real estate? We like leverage. And so what we're doing, if our clients are larger income earning clients, typically have spouses that don't work, right? And they do typically like to have a portion in real estate. And that's when we're going to use the cost segregation bonus depreciation to help bring down some of that income right there, particularly with the One Big Beautiful Bill bumping it back up to 100%. There, we're able to use leverage to get large deductions on there. It's not listen, it's not a perfect world. I do want to state right now, I'm not a CPA on this. So you definitely need to have a good team around you to pull this off. But that is one area that real estate can really help in, particularly with this new bonus depreciation rule kicking back up to 100.
Yeah, no, it makes it challenging I'm not, quote unquote, through the IRS a real estate investor. So I can't, so that doesn't work. I can't.
Totally.
That, but a lot of real estate investors, are full-time are elected as full-time real estate investors. So, like Ian's got that good benefit on that guys, but that's how, most of his income's derived from,
Yeah. So I guess it's a good idea of saying, okay, what if I'm not a real estate? What if I'm a W-2, right? So the first thing we're going to do is we're going to go check that box. If you're in a high income tax bracket, right, we're going to check that box to do a standard 401k, right? Now you're getting the tax deduction now. And ideally, you're going to get the tax deduction now at a 32% tax bracket. And then we're going to take the money out in retirement at a 12% tax bracket, right? Now, if you're in 24% or less, maybe we look at doing the Roth IRA. which is basically pay taxes now, but never pay taxes again, right? So a lot of people fall into that category, and it really is a personal preference there, and working with a financial advisor to get what's right there. I'm also a massive fan of an HSA. The HSA is the most tax advantage financial account in our tax code. You get the tax deduction up front. You can invest it. It could grow tax deferred. And as long as you spend on qualified health expenses, it's going to come out tax free, right? And guess what, guys? One of the largest expenses in retirement is going to be health. You will spend that, right? And then
that's limited. That's only what, $7,000 a year, right?
$400 a year, $8,600 a year, something like that. Now it will add up over time. So I think the mistake that people make is that A, they don't max it out, B, they don't invest it, and C, they actually use it. Why would you take money out in the most tax advantage thing in the IRS tax code, right? Don't use it. Pay cash. Keep your receipt. At any point in time, you can go get reimbursed. 20 years down the line, let's say you have a surgery for $10,000, right? 20 years down the line, you can go back and get reimbursed at $10K. Well, what happened in that 20 years? Well, it doubled twice, right? 10K became 20, 20 became 40, right? In a very tax advantage way. Take that 10K out in 20 years. Now, at the end of the day, if you need the money, you need the money, right? And use it as it's supposed to be used for, right? But if you're diligent about keeping receipts and things of that nature, you could save this money on day one of retirement, take out $100K tax free from all the medical bills, and probably still have a couple hundred left in there to help offset long-term care costs, long-term care premiums, right? Things of that nature.
Yeah, I don't use it the right way.
Yeah,
that's why
I put the money.
That's why I'm here, Jason. That's why
I put the money in at the first of the year, and I was like, okay, cool. I got $8,400 that I can spend on medical, and then that's just my bucket.
Yeah.
Well, that's what they want you to do, right?
Yeah, I mean that's originally the intention around it, right? But I mean,
that's just my bucket.
Let's have some fun. Let's go crazy, Jason. Let's go crazy.
That's just that's literally okay, cool, just use this card and we don't have to spend any money on medical for the whole year.
Is that transferable? That's transferable, like as you pass, later on.
Ian, that's a great point. You really do need to spend it in your lifetime. I think it is, but we do want to spend that one during our lifetime. So guys, when we're looking at retirement accounts, we do want to look at it as buckets of money, right? One of the biggest retirement mistakes I think people make, and this is what we see with DIYers, is that they think that all their money should do the exact same thing, okay? They want to put it in dividend-paying stocks that produce an income stream, and they want to, if they have $1 million, live off the $50K a year that it produces and never touch the principal. I get it. It's simple. It's beautiful. Man, that makes sense. Do you even need a financial advisor to help you with that? Yeah, that's debatable, right? But it's also wrong. Okay. And we want to look at our money, buckets of money, right? So let's talk about the first bucket that I would recommend spending now. It would be your 401k. It would be your IRA. Why? Because think about this. Let's say you have 3 buckets. You have your 401k dollars. You have what we call taxable dollars, which is just a brokerage account, stocks and bonds, right? And then you have a Roth IRA, okay? Or cash value life insurance. They both kind of get taxed the same way, right? So when we look at those, if they're all going to grow and they're all going to compound, right? Well, we want to take money out of the IRA first, because if that money compounds, guess what also compounds? The amount of taxes you're going to pay when you take that money out, right? So the longer you leave that money in, the more taxes you're going to pay on that money. And that's the worst account to leave to the next generation. Why? They have 10 years to spend it down, and typically they're inheriting that at age 50, which is their peak earning years. So more money going to Uncle Sam, right? So we like to have buckets of money here. The IRA is the first thing that we want to spend down. The second thing is going to be the taxable dollars. And the last thing is going to be the Roth IRA and the cash value, anything that would be considered a tax-free asset, meaning once the money gets in there, it's never taxed again. Why? Those are great assets to leave to the next generation. And it's the most tax-advantaged account that you have. So we want to leave the money in the most tax-advantaged accounts.
Okay, explain that first one again. So your 401, so you said your 401k should be the first one that's spent. So
you got it. The traditional 401k.
At 62 or whatever, 65, when you have to take minimum distributions, you're saying take that, spend that.
You got it, right? So it's minimum
and don't inherit. So the next generation doesn't inherit those actual funds. You want them to inherit other stuff.
You got it. So guys, theoretically, if your traditional IRA, your taxable dollars, and your Roth IRA are all going to be invested in the market, they're going to probably get similar rates of return, right? So they're going to compound over time, right? Well, the only one out of those that you got to pay income tax when you take out is your IRA, right? So let's let the other two buckets compound over time and grow. And let's take money out of that IRA first. And that's going to limit the amount of taxes you pay, right? Now, what that inevitably leads to is that means that we need to invest the IRA different than we invest the Roth IRA, right? If our time period in a Roth IRA is much further away here, then we want to be all growth in that sucker, right? If our IRA dollars are what's going to be producing the income stream, then we probably want to have more dividend paying stocks and bonds in there, right? And then the taxable bucket, that's the fun bucket here, right? Yes, there's no tax advantages here, but it's fully liquid here. And that's the bucket that we can invest and go get a securities-backed line of credit against. What is a securities-backed line of credit? It's like a HELOC, it's just investments. It allows you to borrow against your investments. What does that do? Two things. Number one, emergency fund. It is a security blanket. If you need money and the markets are down, it allows you to borrow against it and then come back later on, and once the stocks recover, you can then sell the stocks to pay off the loan. What does that mean? That means we probably don't need many bonds in that account. We have a security blanket already, right? What does that securities-backed line of credit also allow you to do? It allows you to be opportunistic, borrow against it to go do other things like, what Jason does.
Interesting. That's the first time I think I've ever heard it explained in that fashion. And then I think the other thing is it doesn't like the Roth IRAs and some of those other things. If you do have to you're eventually we're all going to die. Let's just be honest about it.
Yeah.
But when it transfers to your next of kin or wherever you're sending it, isn't there like a 10-year window that you still have? Like if we're old enough now to be inheriting stuff from our parents, there's still like a 10-year window that you can run, right?
Yeah, hey, 100% in. But but it's going to come all to you tax free, right?
Right.
So
yeah.
It's 10 years, and we want to stretch that as long as we can. Basically, what they're saying is you can't have that money grow tax free forever. You got to get it out of there and put it into another bucket that then they're going to be able to get taxes from on that bucket, right? But the difference, it's still 10 years, but the difference is the Roth IRA is not going to affect your income tax bracket.
Yeah, we had an investor recently put money in. He's like, oh, it's for my mom. I was like, okay, I need her info. He's like, no, she passed. I'm just investing her IRA. I got 10 years to get paid back. I said, all right, bet, let's go. And that's where I learned that one. So that's interesting. Since we're on the topic of death, since you made it so bright and fun today, what's your thought process on whole life insurance policies versus term policies?
Yeah, great question. Yeah, so death and taxes are the two certainties in life, and the sooner that we face death, the better off we're going to be on there. And so I am a big fan of number one, getting the right amount of life insurance. And the right amount of life insurance is probably much higher than people have right now. Okay. Why? Because life is so much more expensive than it was probably the last time that they went and bought life insurance. If you have $1 million of life insurance, without me knowing your situation, right? If you've got a wife and a spouse in a house, and that's it, sure, maybe $1 million is fine. If you got kids, I mean, we used to kind of our go-to is like $2 million. Now we're looking at $3 million, sometimes even $5 million of life insurance. This world is so damn expensive now, right? And so the way to look at this, guys, is take $1 million, and I think that we could potentially get what we call a 5% yield on that. Conservatively, it's probably more like 4%, right? And what does that mean? That for easy math, let's say for every $1 million, I can give a spouse $50,000 a year. Okay. All right. Now, how many $50,000 a year does your house need to survive? Right. So when you're doing financial planning, I'll say this: the problem with life insurance is that it's oversold. Okay. And then it's pushed on people. When you're doing with a true comprehensive financial planner, we actually put your plan into an analysis, and then we kill you, right? We kill you in the analysis, and then we put in the amount of money to get you back up to where you need to be, right? So we truly doing planning around the amount of money, right? But an easy way to think of it is, hey, how many $50,000 a year do you need to run your house, right? Well, okay, so if it's $200,000 that you need to run your house, and your wife's bringing in $100,000, right? Then we need $2 million of insurance on you, right? If your wife's bringing in $50,000, we're going to need $3 million. If something happens to you and your wife's going to need to stay at home full time and not work, then we need $4 million, right? And we don't need $4 million forever, right? But we might need $4 million right now, and then we work our way back. So step number one is that before even thinking about term or permanent, we got to make sure we're making the right check. Now, here's the deal. $4 million of permanent life insurance is going to be very expensive. Okay. So that means the majority is probably going to be in term, right? That being said, the real question that you're asking is, am I a fan of whole life insurance, right? Because it is the most polarizing instrument in the financial planning space. And I do not know why. I think it's because polarization sells. Dave Ramsey is very polarizing and he sells, right? The political landscape everywhere is all about polarization, right? And so I don't know why, but whole life insurance, it's either a miracle or it's the dumbest thing that you've ever done, right? And it depends on which YouTube video you followed last. Here's my pitch.
That's a fair assessment. That's a good way to say it.
Depends which way the wind's blowing is how we feel, you know? So
exactly right. How'd the stock market do yesterday? Oh, life insurance max, right? Because the stock market's up, right? Let me just pitch something very radical. What if we were to be moderate about this? What if we were to say, hey, life insurance is a very interesting tool with very interesting loan provisions, very interesting tax benefits, and very interesting safety measures, right? And maybe it's a piece of our overall puzzle there that helps complement our other puzzle pieces. Okay. So rather than it being all in that, so you know, in today's world, I like to joke around that we got our real estate bros, we got our crypto hoes, and we got our stock junkies, right? And then over there, we also have our infinite banking life insurance slingers, right? Well, okay, what if instead of going all in on one area, we were to piece together a puzzle that has some of everything, right? And that these parts work together like a symphony here so that the sum is bigger than the individual parts. And that is, to me, what whole life insurance does, is it gives you a safety net and a really good cash value to loan against with really good loan provisions here that's going to allow me to be more aggressive on my offensive game plan here, right? So do I own permanent life insurance? I do. Do I believe in it? I do, right? Is it the only thing I do? No, it's not, right? But how do I utilize my permanent life insurance? I do. I put money into it every single month there, and then I am constantly borrowing from that cash value. And let me tell you something. It's the best loan I've got. It's the lowest interest loan I got. I don't have to pay the interest. It capitalizes into the loan. It's safe. I don't have to worry about the markets going up and down. Now, do I still use my HELOC and do I still use my securities-backed line of credit? Yeah, man, I got all of them, and I like to use all of them, right? But the life insurance is something that I got very early on when I was young. It's done me very well, and I borrowed against that multiple times to go purchase real estate, which has done me very well as well.
Yeah, I think that's a
good way to sum it up. That's good, and I agree with that because, like, Ian and I both have infinite, whatever the heck they're called now. Infinite banking whole life policies. I'm like, sure. I don't know why I'm drawing, and like, you know, I talk to guys that like that's all they do. Your whole life has to be run by that, and then you know you hear the Dave Ramsey, that's a scam setup.
Totally.
Yeah. And I'm like, damn, who's right? And the answer is I think Ian and I are both right based on how we structured it for our lifestyle and how we want it. I'm not going all in where every dollar I get, I'm going to go buy a new policy. Like I'm not doing that, but at the same time, you know, I have a good amount in there that I also like to use the word diversification with that.
Oh.
You know, I diversified into this. You know, there's a few people that would be like, yeah, I don't think you're going to like how the results are. You know, when you see it down the road, maybe
yeah,
not.
I mean, to Alan's point, like, I have a whole life, but then my wife's got term. She's got way more money than I do, and it's a running joke around the house. I said, babe, if you're gone, I have to completely replace you running the whole household. Whereas you still run the household, take care of the girls. You just need a lump sum to turn around and invest and divest everything else we have, and you'll be fine for a period of time. And I love the fact, you know, we're talking about death, so I don't know about love, but I like the idea that you're talking about like how many 50,000s do you need to cover your lifestyle? Because I always just thought, well, if I have enough to cover my mortgage payment and a few other things, or my mortgage payoff, everything else should be fine. And it's just like sitting here thinking about it, I'm like, damn, that's still a poor way of thinking about it versus saying, man, my wife could get a multi-million-dollar sum or whatever it is. You know, it could be hundreds of thousands of dollars. It doesn't matter. They just got to invest it to turn around and be good, you know? So
yeah, let's paint a picture real quick. All right. You know, Ian, let's kill you here. Okay. I'll bring you back to life. All right. Let's kill you though, Ian. All right. Let's say this morning you were driving into work. Okay. And you're going through an intersection and a city garbage truck runs a red light. Okay. Right. And you don't wake up. Okay. And all of a sudden your wife's going to go and she's going to argue for your human life value. which is going to be some sort of function of the amount of money you make and the amount of years that are left, right? And let's say that number is $5 million. Okay.
Right.
But let's say you're a typical W-2 employee, and all you do, because you see this all the time, is you have the life insurance through work that totals $500,000. Okay. And let's say instead of running that red light, let's say that you fall asleep at the wheel and you run into a ditch and you don't wake up. Okay. The difference in the payouts here, whether it's your fault or somebody else's fault, is $5 million if it's the garbage truck's fault and $500,000 if it's your fault. Those two don't add up, right? That is a criminal right there. Yet so many people are walking around incredibly underinsured, leaving their spouse in a very tough situation. People think life insurance is for the kids. I'm going to be clear, it is not. The kids will be fine. The village will take care of the kids. The life insurance is so that the spouse doesn't have to sacrifice everything in their life and suffer incredibly to raise those kids. Okay. So anyways, we got to find something in between what you just mentioned, what we call a needs-based approach. You know, think about a field goal here, right? On one pole, we have the needs-based approach. Let's add up all of our debt. Let's add up the income that our family will need, yada, 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 right? And that's how much life insurance we need. College education in there, right? And then on the other goalpost is that human life value, which is a function of how much you're earning, right? And it's somewhere between 10 to 20 times what you're earning on an annual year, right? Now, as long as we can get the football in between those two, we're giving people a fighting chance. Unfortunately, most people do not have the life insurance in between there. And I would just say, man, the price differential obviously depends on age and health and everything. The price differential to be able to get enough money, what we call critical mass here, critical mass, which is, hey, the income that account's going to spit off is going to be greater than what you need. Therefore, the principal is going to be there. The price difference between that and you getting the needs-based analysis, which is just barely enough, is going to be very minimal, right? And all of a sudden, if we can reach critical mass, which is not only with life insurance planning, but also with retirement planning, where the money doesn't go down, the money stays level or it grows, right? If we can reach that critical mass with your life insurance, not only did you provide a lifetime income stream for your spouse, right? But you also provided a legacy for your kids. So say that number's $3 million and you have 3 kids, right? Not only are you providing an income stream for that spouse where they don't ever have to worry about money, they could just stay at home and be the best wife and not go marry that jackass attorney down the street because they need money, right? But we're also going to create a legacy where we're going to be able to leave $1 million to each kid as well.
Yeah, that's you start talking about death, shit gets deep real quick. And I think the overall conversation here is that, you know, you really need to have a good financial plan, and you could just invest in real estate and be fine and have multiple different ways to do it there. But you still need to have other conversations to ultimately get you to your end goal. So, I mean,
and Ian, let's touch base on one thing real quick. Yeah. So people have talked about life insurance a lot. What is really not talked about enough is estate planning. Okay. It's estate planning. So here's an example for me. I'm a diversifier. I like to layer on financial assets, a little bit of this, a little bit of that, a little bit of this project, a little bit of that project. I'll be transparent with you right now. If I didn't wake up this morning, I don't know if my wife knows the people to call to check in on the investments that I'm in. And I'm a financial planner. Okay. Now, with that said, do I have a living will? I do. Do I have a health directive? I do, right? Do I have trust set up? I do. Why? Because I'm a financial advisor and I got to walk my talk here, right? And most of the people listening here probably don't have that set up. And if that's the case, would love to talk to you. I'm not an attorney, but we could direct you in the right way. And maybe it's a $500 software that driven by AI that can help you get there, right? Maybe it's the lawyer and your employee benefits for $20 a month that can help you get there. But if you own a lot of real estate and you own businesses, we're going to need to get you to an attorney, right? And so getting that knocked out is a one-time expense. Yes, we'll need to update it every now and then, right? But the big haul is up front here, and so many people do not have that done. So I just want to emphasize estate planning here. And I think that the biggest thing to any financial plan is getting a very, very clear understanding of where you are financially right now. Because everybody wants to know, how am I doing? Where am I at? Where do I need to be, right? So you get a very clear data point on where you are, and then a very, very, very clear vision of where you want to be. When we have 2 data points, guys, we can draw that straight line. And that straight line is the most cost-efficient and tax-advantaged path from where you are to where you want to be. And inevitably, that endpoint is a legacy.
Yeah, that's very, very deep. And so appreciate you bringing all that up. I've just went through a bunch of estate planning stuff, building trust, all this. I still, some days I'm like, this is right. Like Jason said about the whole life policies, and other days you're like, what the fuck am I doing? Like, what is the point of all this? But in the end, you got to do something and take the steps in the right direction.
Well, real quick, you also can do it in baby steps. It's very overwhelming, just like everything. Everything is overwhelming. And I think, as you mature, you realize it's like, hey, I don't have to go 0 to 60. Some of these people are like, hey, I've never invested in a property before. I need to go create an entity. Then I need to go to trade a trust, and I have to go do this, and I have to go do that. And it's like, settle down. Like, go look for a house that you want to buy. Go try to raise some capital, take action, and start doing stuff and work things one by one. And we Ian and I both kind of like saying like 101, 201, 301, 401 stuff. And I think we're kind of in the middle at this point. We've agreed the estate planning stuff and also the estate planning stuff for most people, they don't think it's relevant until they get older, right? So some of that goes with maturity, and I'm not saying it isn't like it's relevant immediately, but going from experience, we were like, okay, we'll get to that later. Let's go make money first and then figure it out. And that's not the answer. But I think a lot of people fall in that trap, and
100%.
They want to spend, if they're going to spend money on things, they're going to spend money on things to make them money, not necessarily like save them or
And I'll say this, guys, for the longest time, I've been doing this for 15 years now, and probably for years 5 to 10 here, I would say that I was more than anything just a hand holder. Like, okay, this step and then this step and then this step, because the truth is, guys, is that information is not the problem. There's so much information out there. You can go buy my book right now for $20, and it's a step-by-step guide on exactly what I charge people sometimes $5,000, $10,000, $15,000 to do, right? But here's the deal. The reason I'm willing to give that information away for $20 is you're not going to do it, right? You got to have somebody to help you hold you accountable and help guide you through these steps here to make sure that they happen, right? So on one hand, we're hand holders. I would say this, though. Now, the last 5 years of my career, what I really am, I'm a team builder, right? I'm helping people build their professional team around them. You're only going to go as far as your team. And if you're asking how to do things, you're asking the wrong question. You're never going to get it done. It's going to be slow. It's going to be stalled, and it's not going to be done well. You got to start asking who can help me in this area. And that Who Not How, which is a great book, highly recommend, right? That concept's going to help you accelerate your wealth building astronomically.
Yeah. Alan, that's awesome. Where's the best place people can find you on the interweb? They want to get you, they want to get a copy of your book. They want to reach out to you. What's the best way people can go about that?
Absolutely. If you go to my website, that's empowered-money.com, empowered-money.com. There's a couple of resources on there. Number one, a link to the book. Would love for you to buy it, read it, review it for me. And also tell me how I can make it better. There's a whole chapter on real estate in there. Second thing is that there is a free 10-minute financial plan in there, right? It takes 10 minutes, it's complimentary, and it's going to really help you get a better idea of where you are financially and your trajectory on that. And then third thing is that you can schedule a 15-minute meeting with me personally, not with one of my junior advisors, not with my staff. You can schedule a 15-minute phone call with me personally. We can get to know each other, and we can maybe determine how and if and how we can help you accelerate your wealth growth.
Right on. We'll get that in the show notes. Alan, this has been awesome. It's a good reminder of everything we should be doing. As Jason said, some days it's easy, some days it's hard. And honestly, guys, if you got any value out of this show, the best compliment we can give Alan is by sharing it. We appreciate you, brother, coming on. Look forward to the Phillies winning the World Series this year, and we'll catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.